One of the biggest obstacles preventing people from purchasing a home today is simply saving enough money for a down payment. I understand, it's scary. So, this video will give you an abbreviated version of basic loan programs that are out there. Think of this as like your Mortgage 101 guide to loan programs if you're new to home ownership. So, I'm Kim Abbas with Thrive Mortgage, and I'm here to give you the lowdown on the best low down payment mortgages. So one of the most widely known low down payment programs is the FHA, or Federal Housing Administration Loan Program. There are definitely some benefits to this FHA program. For example, some of the pros of the FHA loan program is that the credit requirements are not as conservative or as restrictive as, say, conventional. So for example, you might have a score as low as a 580 and you could still potentially qualify for a down payment as little as 3.5%. Another positive about the FHA loan program is that you can use it to purchase anywhere from a 1 to 4 unit property. Say you've got your eye on a duplex, that could still qualify. The other benefit, depending on who you ask, is that mortgage insurance premiums are about 0.85%. This is comparative to the private market, so it is relatively low. However, there are some drawbacks to the FHA loan program as well. One of those drawbacks is something called upfront mortgage insurance premiums. So, you will be charged 1.75% of the mortgage up front if you decide to go with an FHA loan. So this is why many argue that FHA loans are more expensive. The other drawback is that you cannot drop your FHA mortgage insurance, which is rolled into your monthly payments. You will have that rolled into your monthly payments and for the entire duration of the loan, or until you refinance or sell the property. This is unlike conventional loans, which will allow you to drop off the mortgage insurance once your loan to value reaches 78%. So with conventional loans that offer down payments as low as 3%, there are some pros. For example, there is no upfront mortgage insurance premium, unlike with an FHA loan. The other great thing is that your private mortgage insurance, or your PMI, cancels at a 78% loan to value ratio, so it does not stay through the entire duration of the loan. And as mentioned before, you can put as little as 3% down, which is 0.5% lower than an FHA loan. The other great news is that, like FHA, you can receive the down payment as a gift from a family or friend. Last but not least, you will have to have a minimum FICO score of 620 to qualify for the conventional loan with a down payment as low as 3%. Like anything in life, there are a few drawbacks to doing a conventional loan with as little as 3% down. A few of them to mention: one, you cannot have owned a home in the past 36 months to qualify. In addition, you can't have a debt to income ratio that exceeds 41%, so it must be 41% or lower. Then of course, you are getting a slightly higher interest rate than you would if you were to do an FHA loan. However, keep in mind that because you are putting so little down, you are saving money on the front end. Last but not least, unlike with an FHA loan, you can't purchase a multi-unit home. We also don't allow people who are looking at purchasing an investment property to qualify for conventional with a 3% down as well. Now that we've discussed at least two of the low down payment program options, FHA and conventional, I want to leave you with some last thoughts. One of the things I really want to press upon you is not to think that private mortgage insurance is bad. It's not necessarily bad. What it is an insurance policy that lowers the risk for lenders. That's the bottom line. However, if you want to get into a home sooner rather than much later, this is a good option for you because it allows you, one, to get into a home that you want, two, start accruing that appreciation on that home, and then last, avoid paying rising rents in today's economy. So This is why these options exist, so that people like you can take advantage of home ownership. I hope this answered some of those questions that you might have had. Please know that this is not an all-encompassing, comprehensive overview. In fact, there's a lot of other details that go with it. So what I really want to advise you to do is to get in contact with a mortgage lender. If you'd like to follow up with me or my husband, we would love to look at your options, do some different loan scenarios for you, and really give you not just your short-term costs, but your long-term costs that fit in line with your overall goals, so that we can determine what is going to be the best fit for you. In the meantime, please send us a message, answer questions, pick up the phone, call us, follow us on our Facebook business pages and our YouTube channel, and I look forward to doing another video for you very soon. Thanks, and have a great day.